The recent meetings and press conferences of the Federal Reserve and the ECB have confirmed that the message remains unambiguously hawkish, perhaps slightly less than in the past, but nevertheless the determination, the decisiveness to continue tightening policy is still very much there. Nevertheless, financial markets are pricing in rate cuts already towards the end of this year. This seems odd. It's kind of reminiscent of what the first ECB president, Wim Duisenberg, used to say at his press conferences, "I hear what you say, but I'm not listening." Are we now experiencing an example of markets not listening to what central banks try to convey as a message? Two explanations spring to mind. The first one is that there would simply be a case of diverging views, that the economic assessment, the assessment about the economic outlook by markets would be very different from that by the central banks. I think it's highly likely that there would be such a divergence so as to justify this pricing of rate cuts already towards the end of this year. A more likely explanation, which I favor, is actually that investors are rationally managing their risk exposure. Let's now look in more detail at the second explanation. We can actually say that central banks and markets are playing a game of cat and mouse. Central banks, through their decisions and communication, try to influence market developments because that in turn has an influence on the real economy. Financial investors also influence what central banks do and what central banks say. From a central bank's perspective, it is clear that in the near term they will continue tightening policy. Core inflation simply is too high, and we have not yet reached the terminal rate of policy rates. It is the peak level of official interest rates in this cycle. They will continue policy tightening, but also it is clear that they have no incentive whatsoever to already soften the guidance too early. They have all the time to wait for that and to see how the data evolve. Actually, central banks have the option at any moment in time to change their message to the markets. And the timing of using that option to change the message will depend on how the data come in. The market's perspective is to some degree the mirror image from that of central banks. Markets know that an unexpected change in guidance would have a major impact on bond yields. Softening of guidance would mean that bond yields would drop and equity markets would rally. Markets also know that central banks have the option to change their message at any moment in time, and that adoption depends on the data. Markets also remember that in the past central banks have already surprised. Think of when they started tightening policy, which also came to some degree with a surprise. So it means that investors know that if you wait until the big announcement is made, it will be too late because everybody will try to squeeze through the same door. Markets also understand that the smaller the gap between the current level of policy rate and the terminal rate, the higher the likelihood that the central banks will actually start to change their tone and will adopt a more dovish communication about their future policy intentions. And as a consequence, investors decide that it is better to anticipate rate cuts well ahead of time rather than waiting until they have happened. Central banks have their rationale and financial markets have their own motivation. What are the consequences of this confrontation of these different approaches to the same topic, which is economic data? Well, the first consequence is that by the time that central banks will change the guidance, will adopt a softer tone about what they intend to do in terms of policy tightening, it should be largely priced in by bond markets and by equity markets. The second consequence is that in the meantime, what we're observing is the phenomenon of FOMO markets. FOMO refers to fear of missing out. Investors are afraid of not being invested sufficiently in bonds by the time yields drop further, or of not being sufficiently invested in equities because when interest rates go down or are no longer hiked by the central banks, it should have a beneficial impact on equity markets. So FOMO behavior means you have a very nervous environment. And the nervousness is, of course, fueled by data, because sometimes data are strong. We have seen that with the latest US labor market report, which is really an example of shooting the lights out. As a consequence, bond yields moved higher, and there was a reassessment of the timing of the first rate cut by the Federal Reserve. All this means more volatility. It gives us economists an opportunity to communicate to you, and this is why I thank you for having watched Eco TV Week this week, and I would say, well, stay tuned for further updates. Thank you.